Today, we're on a field trip to a local pub.
Are we allowed to do that?
It's work related, I promise, Jen.
You had me at pub.
Welcome back once again to Fun Finance. I'm Blair Cook.
And I'm Jen Nicholson. Today we are at the pub to learn about how a real business looks through the eyes of an accountant.
We're going to have a few drinks and do something so geeky that I think it's going to become cool.
You'll never be cool, Blair. But we're hoping this is at least educational.
Every company has a business model.
For this pub, it's to attract customers and sell them food and drinks.
It's a business model that's been around forever.
And the perfect place for us to start.
So Jen and I are going to show you how everything you see and everything we do as customers creates a financial transaction.
And then we'll discuss the journal entries. Very exciting.
Easier than teaching cats accounting, huh, Jen?
I still think it went pretty well. Listen, that was your idea. I'm not taking the blame for that one.
Okay, it looks like we're ready to order. What are you having?
I'm going to have a glass of red.
And I think I'm going to have the same.
Now, when we ordered like that, does that create a journal entry?
Technically, no, because all we did was place an order.
Okay.
The intention to buy something does not create the obligation to pay.
So a sales order does not generate any journal entry.
That's right.
Okay, so now our drinks have arrived. Did you pay her, Blair?
Why do I have to pay? I thought it was your turn.
Because I paid last time. And you usually pay, actually.
I opened a tab. We might be here a while.
So now we have a whole bunch of things to sort out from an accounting perspective. Let's start with the delivery of the drinks.
Once delivery has occurred, the business part of the deal is done. And we're obligated to pay for these drinks. What's the journal entry for that, Jen?
Well, the sales account will be credited for the price of 2 glasses of wine, but the debit is a little trickier to think about.
That's right. No cash has changed hands. So that's not it.
But you do owe the pub the money for these drinks. So the pub has an account receivable from you. That's the offsetting debit. Are we done?
Not quite, Jen, because we must not forget we have to adjust for the fact that we're consuming the pub's inventory, and that is the wine.
And I'm going to consume it. What's our journal entry for this?
Well, the pub's inventory of wine is an asset with a debit balance. Now, the waitress has just drawn down that inventory to give it to us. So we need to credit inventory to reduce the balance.
And we debit cost of goods sold, which is an income statement account.
Yep, so let's toast to that.
Cheers!
So while we are enjoying our drinks, what are the other journal entries do we see around us?
Well, the wait staff, they're a cost.
What's the journal entry for them?
Well, the wait staff earn wages from the pub. Wages are an expense, so we would debit the wages. But where would we put the credit? Businesses don't pay their employees every hour.
No, they don't. Typically, employees are paid every 2 weeks. So as the employees work, if we were to record the amount of wages earned each day, the offsetting credit would be to an accrued liability account.
Which represents the balance of wages owed to the employee, right?
You got it.
What else do you see around here?
Well, the pub has a lot of furniture and fixtures, from the table and the chairs to the lighting.
These don't get purchased very often.
And they last for years.
Looks like they last for a lot of years in this pub. So these are called capital assets, and the amount paid to purchase these assets gets initially set up on the balance sheet.
And then as each year passes, these assets get used up until they eventually have to be replaced. So how do we reflect the consumption of these assets by the business over the years?
This is called depreciation. Depreciation is an expense and therefore a debit balance. What is the credit side of the entry, Blair?
The offset goes to an account called accumulated depreciation, which is a so-called contra account to the capital assets on the balance sheet.
A contra account means that it gets grouped with capital assets in the financial statements. So when you have capital assets with a debit balance netted against accumulated depreciation, which is a credit balance,
the balance declines over time until these assets are used up.
and need to be replaced.
Looks like some of these have been here a long, long time.
I think it adds character to the place.
I agree. Is there a journal entry for that?
For what?
Character, charm, ambiance. I think that adds value to the business.
Well, you're right that it does add value, but in the accounting world, it doesn't get recognized.
I'll tell you, in the finance world, however, we do recognize that value.
Let's save that discussion for another day. Look, here's the bill. Time for you to settle up.
Well, while I'm doing that, why don't you talk about the journal entry?
Sure. As Blair pays the bill, cash is being exchanged. The pub is receiving cash, which is increasing the cash account, a debit. The offsetting credit is that receivable we recorded when the drinks arrived.
All done. It's your turn next time.
You're on.
So let's see. We've been here an hour. Let's calculate a customer profitability for Jen and I to show you how this business makes money.
Oh my gosh, you are so geeky.
What? It's all about the money, Jen.
Time to say goodbye.
Until next time.
Cheers.